Folks, the economy is kind of in a weird spot right now. At the end of last year, I put together this chart. On the x-axis, GDP growth, on the y-axis, inflation, and I thought these were the two big things that were going to tell us how the economy would evolve into 2025. So back then I said we're probably headed for a soft landing, inflation was cooling, GDP growth seemed to be happening, the economy's chill. This is great, right? Well, things maybe aren't so chill anymore. I think we're trending closer toward a growth recession or stagflation. And the three big headwinds, as I'm calling them, there's just a lot of uncertainty about the economy and the market. There is unclear GDP growth, and I'll talk more about that in a minute. And inflation seems to be coming back up a bit. As far as overall uncertainty, you can see on this chart here that there was a big spike in uncertainty at the beginning of 2025 as tariffs were announced. These are big tariffs. In the run-up to the announcement of the tariffs, a lot of people were wondering, was the Trump administration calling tariffs just a campaign trail thing that you say to get elected, or are they really going to happen? Well, it seems like at least he's trying to roll them out. You can see the peak there was a few months ago, but really these tariffs have been kind of like the tide. They're in and they're out, they're in and they're out. So quite honestly, the economy is figuring out how to deal with that, but uncertainty is still elevated. Moreover, consumer sentiment is still lower than when we were in the pandemic. It hasn't recovered to that level. The tariff announcements pushed that sentiment even lower. I think intuitively, a lot of us understand that if and when tariffs are fully implemented, they are going to result in higher prices for consumers, most likely. The economy is a dynamic thing, and, well, things are going to change. A lot of uncertainty ends up being tied to jobs and unemployment. The unemployment rate from a historical perspective is still kind of low at 4.2%, but it does seem to be ticking upward. And this orange line here that I have, an interesting factor I see is that labor force participation, or people like getting jobs and working in the economy, that seems to be falling as well. So when people are sitting on the sidelines and they're not feeling so confident about their jobs, they tend to be uncertain and think the economy isn't doing great. On the right, I find this chart real fascinating. The most educated employees are having their worst expectations about unemployment and just economic growth over the next year. So three lines here. This is by educational attainment in blue, high school education or less, red, some college, green, at least a college degree, and sure enough, they have the lowest how they think the economy will go. I do wonder what is driving that, though. Is that because AI is ascendant and might be coming for white-collar jobs that are typically tied to a college-educated degree, whereas it's less likely to automate a blue-collar job, which has probably already been automated over the past 20 or 30 years anyway? Is it politics, which I'll show you a slide on that in a minute, or is it something else? The politics one makes me laugh a little bit. So what I'm showing here, and this isn't the longest time horizon ever, it only goes back to 2017, but these are Republican in dotted black, Democrat in green, Independent in blue. And the big takeaway from this slide is people feel like the economy is going well when their guy is in office. Democrats feel the economy is strong when a Democrat is in office. Then it flips. When a Republican is in office, they don't feel so good. Same thing happens for Republicans. When a Democrat is in power, oh, the economy is the worst. But when a Republican is running things, oh, the economy must be great. The takeaway is for all this consumer sentiment stuff, there's a my team, your team thing that happens. Take everything with a grain of salt. Now, moving forward, unclear GDP growth. This is from the Bureau of Economic Analysis. This is GDP growth by quarter. And in Q1, you saw it was negative, which garnered a lot of headlines. Q2, it was really positive, which again garnered a lot of headlines. Why is it vacillating so much or jumping around? I think some of this is just an artifact of how GDP is calculated and reported. So this first chart here, what I'm showing is Q1 2025, and these are all the components that feed into a GDP now estimate of real GDP growth. That's kind of a mouthful. The takeaway here, in this time period, Q1 2025, imports were greater than exports, which, if imports are bigger than exports, that depresses GDP. And you can see it right here in this, I don't know, slate blue, whatever color that is. Net exports are negative. People were bringing more in via imports because they wanted to get ahead of tariffs. If they thought that they could stockpile, then great, they'll do that before tariffs end up crushing them. And you see that shaking out in this purplish berry color where the change in private inventories. They went up. So this is why Q1 was so negative. Imports were bigger than exports. Q2, the opposite happened. Imports were less than exports, which kind of goosed the economy. Say, oh my gosh, it's really growing great. Companies stopped importing as much as, once again, the slate blue or whatever color that is, relative to what they were exporting. Imports were down, exports were up. That looks like, my gosh, the economy must be on fire, which I think it was just a rebalancing. And in purple down here, now you can see that companies are working through their inventory, selling through their backlog. So that's what kind of explains, let me back up a second, why this one was down and this one was way up. I think just an artifact. It's not, I wouldn't call it, it's not that it's not real, but it's just kind of a special circumstance related to tariffs. So as we move forward, inflation is starting to ramp back up. Right here, what I'm showing is the producer price index year over year numbers, and I have it broken down into two: goods, physical stuff, versus services. In light blue, services are finally seeing their inflation slowing. For a long time, it was elevated. It just doesn't respond as quickly to change as goods do. Moreover, services generally aren't hit by tariffs, right? You can't, it's hard to have tariffs on a haircut, which I could desperately use. Durable goods, however, things that are hit by tariffs, we're starting to see this actually have an impact and drive inflation. Keep in mind, just because somebody makes a decision somewhere doesn't mean it happens all at once. Things tend to flow through the economy over time. And remember, on that prior couple of slides, companies were still working through their backlog of inventory. They didn't have to import at higher costs and therefore push those costs through to price for their customers. So that partially explains why there's a little bit of lag in terms of tariffs hitting and flowing through to price. But I think we're starting to see the beginning of tariffs biting people with higher prices. Moving forward, on the left, this is the GDP nowcast. This is the number that the Fed cares a lot about when it comes to what they think is happening from an inflationary perspective. And this gold one is the one they really care about, PCE inflation. It's elevated. It's at about 2.8%. This is higher than the Fed's 2% target. For a while there, we were almost at that 2% target, but we're getting away from it. So there could be aggregate or overall inflation. And one of the final charts I wanted to show you is that really the Fed is battling increased unemployment, which should imply a rate cut, and increased inflation, which should imply a rate hold. They're kind of caught in between. It shows right now from the Fed Watch tool from the CME, by the end of the year, December 10th is their meeting, you can see that up here, the market's predicting a 100% chance rate cut by that time. And it might be a pretty healthy one. Right now we're between 4.25% and 4.5%. There's almost 60% chance of getting to 3.5% to 3.25%. That'd be a pretty healthy cut. So we'll keep looking at this. I think as we are in the great wait, as I'm calling it, certainty is tough to find. We're going to just have to see how things evolve. I'm going to keep watching it. I'll try to report a little bit more regularly on it, but that's what I'm seeing. Thank you for spending a little bit of time with me, and have a great day. Goodbye.